Hey guys, this is Julie. I'm going to go over the new quarterly distributions. We've got a new quarterly roll in the option agreement and take a look at that and also look at where the dealer call collar is and to remind ourselves that that's also sitting there and why I think we have a very bearish case setting up for the market over the next near term, especially given all the macro with the bank regulatory coming in on the regional banks. Um, Given the structure of the distribution with that macro, it's presenting as a bearish case at the moment. There's plenty of downside movement available to move to these lower strikes in the quarterly distribution. This is quarterly. But with this said caveat, anything can happen in the market. Warren Buffett could come in and say, yes, I'm going to buy every single regional bank in the world. And Xi could be in Russia next week saying, I really don't want you spending a day more in this ridiculous war because I want EU and US paying China, me, for their um, supplies and not, you know, military defense. Who knows what's going to happen next week? So, with that said, trade what's in front of you. Just because we're building a bearish case today doesn't mean that the market can't flip on a dime. And so we have to be prepared as traders to go long and short. Don't get married to a position, okay? So, this is a daily chart of the ES, and I've got 30-day, excuse me, I apologize, 90-day, this is quarterly, 90-day, 3 month, and 12 weeks, right? 4, 8, 12 is 3 months. And so I've got my white lines, and you can see my means are in the middle, and we're closing below the means. That gives me that bearish case, and that's leading me to come down in the distribution because we're below the means. Um, we can look at the option flow after we review the distributions. Um, so these are daily bars. Friday, we saw that on an intraday level, the quarterly one calculation on a 30-minute came exactly where the dealer put his put wall. The dealer put its put wall, not his put wall, sorry. Mr. Morgan, Mr. JP Morgan. So the calculations on a daily are different because of the close are different, right? So JATS PT does all this for you. So you have to look at the intraday level as well as the daily level, is what I'm trying to tell you. And on the intraday level for Friday, my calculations, we can run JATS PT calculations in the market analyzer and for NinjaTrader, and we could see that it was 74.50 for the daily full range. And when we get the ruler out and measure from the top to the bottom, we can see it was pretty much 74.50. Let me actually get the top. The high was 4,925 and the low 39.32.50. $76.25. So target reached 74.50 and the range was stopped on a dime at the quarterly 3. This is a 3 month month three. So these ranges are pretty accurate, right? We got to the end of the daily range, and you can take your profits. And on a day like a Friday, you necessarily wouldn't expect it to turn around and rally back up inside the mean or anything like that. It just stayed off the the put wall held, and the trade was basically over at that point. Um, so we can rely on these ranges. Now, if the range breaks, which can happen and does, you know, ranges do break, then you get into a situation where you're looking for a lower standard deviation level or a tail. And for um, Monday, we can see that we're setting up to set up for Sunday night below the first standard deviation. So we could gap below this put wall, probably will, it's probably gone already, and start exploring these lower strikes. There is a large amount of open interest at 3,900, as you would imagine. And then there's basically puts stacked all the way down to 3,800. So if it gets going on Monday to the downside, it can really take off. Conversely, if we explore that 3,900 and bounce, then we could go back into the middle of the distribution. Just have to play it the way it comes, but we will be wanting to figure out where we are on our daily ranges and be, cognizant that that's really all we want for a normal distribution. If we get abnormal distribution, then we'll look to see where the standard deviation or tails are at that point. So it really helps to have an idea of what your daily ranges are and then where your targets are around them. So you can see here at 38, 66, 75, we've got another quarterly first standard deviation. And why are these first standard deviations important? It's because where the dealers put their risk, their puts and calls. And that order flow you will not find on your DOM, and you will not find it in the open interest on your options platforms because their order flow is hidden. So it very much helps to have an idea of where these strikes are, to expect a little bit of support or resistance at those areas. And then if that breaks, then you know that the dealer is going to be moving their risk down further. Now, the dealer has a call collar at 4065. So we always want to have that on our chart. And for my means, I've just been in the habit of making those orange. And so I'm going to put this at 4065 and lock it in right there. So I don't expect it to go above that before March 31st. But we'll just want to be cognizant that that is there, the 4065, as well as this first support at 3866, which is in range of that first daily normal distribution. Now, think about this. When we're talking about the dealer putting their puts and calls, the quarterly option is just now starting, right? The quarter is just now starting, and there are additional white lines below it. They're not going to put a whole bunch of risk on that first line. It's at the very beginning of the quarter. In fact, there might not be any resistance at all to speak of, minimal, unless they want to keep the market flat and, keep protect their higher lows. We don't know where they're trying to mark the market, but until March 31st, they're not going to be marking the market higher. So I would imagine that that one is going to get taken out pretty quick, just using common sense, right? It's at the very beginning of the quarter. So I'm going to be looking for that 3,800 strike, 37.79, really to attract the dealer order flow. And the 3,800 is the second obvious target for the high open interest. So I'm going to be looking for this 37.79.75 to hold the dealer put. And that would take about 2 days to reach, given this range on a normal distribution. Okay. And that would take us into Wednesday if we continue to go down. Now, caveat emptor, trade what's in front of you, not, if the market does not work out like this, um, you know, don't be, quoting me. It can definitely go up and it can definitely break their 4065, but I'm just going on probabilities, right? Probability theory, game theory. So, I'm really going to be looking to trade down to 37.79 for Powell. And then that first touch, because it's a quarterly level, should probably hold. But what I have is an ability to put a few more lines on my chart, right? So I these are all closes. Remember, the session opens as well. So we have an open and we have a close. So I want to put opens for the 90-day and the 3 month and the 12 week. So that I can do real quick. And for these, I will make that lower one a different color just for this video so we can see the difference. So there's your 90-day chartreuse. Here is your month 3. And we'll make this PT1 chartreuse. I probably shouldn't have picked chartreuse, but in fact, I'm going to go back and change it. We'll make it medium slate blue, and I'm going to go back and change this one medium slate blue to get it away from that other color. And then I'll add a 12-week open and make it medium slate blue. Okay. There we go. So now I have a little bit lower. So instead of that 37.79, or what was it? 38.1650. I'm going to go to 37.80. So I just dropped my risk to 37.80 by doing that. And that would be 1, 2, 37.80. So there's my risk right there. I would be looking for a dealer put around there. Okay. And that is going to be, right after taking out these stops. So, and before we get to these, so you might expect, you might could get a little drop and pop back up, but that first touch of these quarterly levels usually holds. So the benefit of having JATS PT is that you can measure these ranges and you can come up with calculations for the session open at the beginning of the session as well as the session close at the end of the session and can compare them and get bounces off of them intraday as well as daily. And then when you put that together, we all also know what the daily range is going to be, or the weekly, or the monthly. It'll work the same. I can prepare my market analyzers to give me weekly, monthly, as well as the VIX. So, as you can see here, these standard deviation levels work very well. The third standard deviation is um, pretty solid for the quarterly contract because that's where the institutional money is. They don't like breaking the quarterly institutional contract, those spreads, because if the dealer moves the risk from the one, they're going to move it to the three. So at the end of this quarter, right, June, March, April, May, June, then you're looking at 34.29.25, 3400 for a low put. Okay. Now, why do I think this is bearish? Well, we're going to go over to the options in just a minute and take a look at the new quarterly distribution, and I can tell you that this is about as bearish as I've seen, right, for a new um, open interest structure. The term structure is very bearish at this time. Anything can happen, like I said. Warren Buffett can come out and say that all the regional banks are now is, and Chi can say that there's no more Russia war. We'll see. So for the VIX, here's a 30-minute VIX. This works really well. I can put a daily chart on it with tails. And instead of my usual levels that I use, we can make the calculations anywhere we want outside the distribution, including 1 and 1.5 and 2. And let's do a 0.5. So let's do a 0.5, a 1, a 1.5, and a 2. So I can draw lines outside the distribution. And you can see here at the very beginning of last week when we had the two major excursions of VIX outside the distribution that they went 1.5 times outside the distribution. So this 1.5 is on the second level. Let me show you my fib PTA2. Let me thicken that line up so you'll see it. Oh, that's a B, I'm sorry. Make the A. PTA fib 2 right there. There we go. Oh, wrong one. Sorry. Hang on. I tell you, there's something wrong with my memory. What in the world? Okay. I just colored the wrong one. That's it. All right. Memory's fine. I'm just losing it. There we go. There's the right one. Okay, here we go. So there was that 1.5 times, twice in a row. And it didn't reach the 1.5 times the next time it had the excursion up. It went to one time, just a little bit over one time, and came. They slammed it back in. So they weren't going to let it get back up to 1.5. So the excursions, the volatility is rolling over, is what I'm trying to show you. Make a long story short. So they went from 1.5 to 1. And then they kept it inside the distribution. Do you see that? They didn't let it get in the tail. And here it tried to get up to go out, and they kept fighting it and bring it back in. So we do have an elevated distribution going in for Monday. So here we can see the new daily range, and it is higher than the prior right here. There's your first standard deviation, and you can see that that's higher than the prior one. So we're opening with elevated vol. So if we try to get up to that 1.5 distribution again, that's 35.79. That's really up there. And the volatility is rising again. You see how it went down, but now it's going back up. See how it went up and up, but went down, down, and now it's gone back up. So the volatility is leading me higher, higher vol. Okay, Jack's term structure. So I'm looking for higher vol going into next week. And once it raises above 2808, you're going to be in the tails. And so you're going to be looking for that 0.5, 1, 1.5, and 2. And, you know, as memory, you know, whole serves us, we're going to be looking for that 1.5 really hard for them to come in and squash it back in. That seems to be the right one. But you see how otherwise they keep it. Here was one time, one time above. They use these standard deviations just like I do. Look down here, 1.5 below, or one time below. Did I think I messed this up on the one below? I think that's one time 0.51. No, that's 1.5. I can't. All right. No, I've got the wrong one again. I did the two down here. Sorry. Get this right. All right, there we go. So one time they turned it around to the downside. So squashing vol one time, rising vol 1 and 1.5. So just having the ability to measure vol is huge, huge. And on a daily VIX, I can tell you that, let me put the PT2 indicator on here. So I'm putting JATS PT on VIX. So I'm measuring VIX on PT on VIX, giving you a profit target, JATS profit target, PT is profit target, 2.74 profit target for a vol, for a range. So the vol is rising, as you can see. And what is fascinating to me is I can put my 90-day distribution on here, which is dynamic. So let me put my 90-day on the close. And show you a trick. I can add another daily and change this one to oh poo, hang on 1 second. Sometimes there we go. It gets hung up when I'm Skyping. I'm going to add 5,000 days to the second one. And then I'm going to add another instance of the indicator. And go to the input series, select the second one, which is the 5,000 days on the close, and click apply. And you can see it's down here on this bottom one. So all I have to do is move it to the top, and now I have the 5,000 day on the 3,000 day data. Yep, 3,000 and 5,000. Now these are calculated on the close, and I can change the calculations to the open. Wrong one, sorry. Which changes it just a tad. But you can play with both. Let's see, 15, 18, and 14, 29. Let me put it back to the close and see what that changes. Yep, 1566 and 1426. So there's a little bit of a difference. So you can get that difference between the open and the close calculation. Um, and did you see how this went to the second standard deviation versus the first? And if I put this back on the open, it went to the first standard deviation. So look right here where that's going to the second standard deviation on the calculations for the close. But when we change it back to the open, it shifts the distribution a smidge. There we go. So this is the one I think that they use. So you can play with it. Now, the distribution changes also. It's dynamic. And earlier in the month or a week or so ago, this was touching our lines. But you see the bottom lines have shifted down away, and price is reaching up to these upper ones. So they're going to 3168, 2943 and 3168 is the target, I think. 3168, 2943. So if I come back here and look for 3168, 2943, okay, and 3168. I would be looking for vol to go there. on my 90-day current distribution. 274, so 2551 plus 274 for your max range. 25.51 is where vol currently is, and if we add the 274 to that, that's 28.25. So anything over 28.25 is going to be a vol breakout. So here's our 28.25 at our third standard deviation of the daily range. Do you see that? So we already know that we can go in the tails, right, and have that breakout, that Volmageddon type action. The vol breakout where we, is just, you just press going directionally short at that point, and then we would be looking to go to these other standard deviation levels. So it looks like they're going to have a challenge getting over just by JATS PT measurements for this first session. Staying inside this 90-day vol. That can break. We can break the 90-day vol, right? It does break. Look over here. Look at COVID, where it took off and just went to the moon. And occasionally it'll go up to the second standard deviation. It can break the 90-day vol. But I'm just telling you that 90-day vol will probably have your VIX um, calls being sold at those levels for the dealer or the VIX sellers, right? Okay, like this was. So if it breaks 3168, hold on to your sombrero, as I like to say, right? Because we know where the other target is. It's up there at 35.79, as we've seen before up here. All right, so I've given you some levels. I hope you understand what I'm trying to convey and that we can put this to use next week in the market and take our ranges and trade down uh, to our levels. Uh, and then we're going to bring our option flow back in. So I tried to show you this briefly. This is the new quarterly expiry. The max pain is at 39.60. So puts anything below 39.60 are heavily, uh, in action, and arguably up until 4,000. That's a quarterly. But let's take this back to the contract for next week and get out of the quarterly world. I have another one to show you. I can pull it up. Here we go. So here's Monday's open interest, and the max pain was at 39.60. And you can see that we have that 4,000 calls and puts right there. But we've got a call wall at 3,900, the blue, for open interest, and then anything below that, the puts are stacked. And let me show you that. I think I closed my quick sheet. So we'll just start over. So I have open interest, put open interest, and call open interest. And I'm going to put my call puts below the calls. Sorry about that. Had it in the wrong order. So here's the open interest, open interest, and put open interest. Calls and puts. And so for Monday, 39.45 is going to be the middle, and 3900 has 2000 puts. 3925 has 1282 puts. So there's a little bit of a bumper before we get to the 2000 puts. 3925, 3900. And then if that breaks, then it's a straight shot down to 2175. And then, so that's your high strike is at 3840. And then here's your 3800. 3920, 3900, 3840. So here's your 3920. $39.25 rather. 3900, 3840. 3900 is your big strike, and then 3850 and 3840. So we've got a little bit underneath the 50. And so here you can see the 3920. 3925 is going to be your first um, support for a third standard deviation of the daily. So they have open interest above it at 39.25. So they're projecting that third standard deviation of the daily. So that's your first support area. Right there, 39.25. That's your daily 3. So if that breaks, it's going to flush quickly to 3900. And that 38.94 is my first tail. So the dealer will probably have a second support put just below that 3900 at my first tail. And if that 3900 breaks, you can see that this pretty much goes all the way down to 3840 quickly. So if this 3900, 3900, 3894 secret put wall, it can go all the way down to this 3844 quickly. And that is 51. That's the fib 3. Right there, a little bit thicker. That will provide support before you get to your 3800. All right. And the 3800 is at the point 68. Point 68 is at 3818. So that's, one standard deviation outside the range. So if we were to put another distribution on here, a daily open, and let me put the tail for that as simply a 1 and make all these zeros to show you where that 1 is. It's down here at 3771. Last call, right? Last train to Clarksville, one time. So somewhere between 3818, 3800, and 3771. But that would be, like 2 times the range. And that's kind of hard to do on a Monday, right? I don't know. 2 times the range. The market would have to have something really, really negative to go all the way down there the first time. So we got to leave some room for Tuesday and Wednesday, right? But overall, the news does look a little bearish because of the macro, as well as the fact that we're positioned below that 4065 call wall, and um, we're heading down to the 3780. And 3780 would be right here at my one time. So I would say 3780 by Wednesday, Tuesday, close Wednesday. Hopefully not Monday. Hopefully it doesn't get done there in one shot. But be prepared for some volatility next week. We did see on the VIX, I've got some circuit breakers coming up with these first standard deviations where they'll be selling it. And so that could provide some, if they start flattening, selling calls, and you start seeing the VIX coming down, you'll know why. They're really trying to get it back inside the distribution and preventing that big breakout to this 3578, which would be, like I said, in the above the first standard deviation. All right, guys. Hold on to your sombreros next week. Hope this helped. And we'll talk at you soon. Thank you so much. Y'all have a good week.